In this video, we are going to be looking at what is known as fractional reserve banking. So this is the type of banking that it's used in the U.S. and I assume pretty much anywhere that has any kind of financial sector. All right, but this is a system of banking in which a portion of deposits are held in reserve and the rest is used for lending. All right, so when we deposit money with a bank, as we've mentioned in previous videos, that money doesn't just go into a little cubby that's got your name on it that you kind of pull that money from. They don't just hold all of your money. All right, they're going to hold some of it. That's the reserves, and then they're going to lend the rest, right? And that's why banks pay you interest on deposits, right? The more deposits they have, the more lending they can do, and that's how banks make money, all right, is off of lending, right? So they lend out money from the depositors at the bank to other people. All right, they charge them interest. That's how they get money, and then they give you some of that interest as well. All right. So to illustrate, let's say banks hold, oh, that's not how you do that. All right, banks hold $1 in reserves for every $10 in deposits. All right, so, and we're going to just say all banks do this. All banks hold exactly $1 for every 10 in deposits, for simplicity's sake, as we go forward. All right. All right. So again, you give them however much money, right, and they're going to take a tenth of that, right, hold it in reserves, and then the other 9/10 they're going to lend out. All right, so let's say that person A deposits $100. Right? They're going to take $10 to hold in reserves, and then they're going to take the other 90 and lend it to person B. All right. So person A deposits $100. The bank holds 10 in reserves, and then they have 90 left, so they can lend that out. We're going to say they lend all of it to B. All right. Then B deposits that money. All right. So I guess B is a he now. Right. So he deposits $90 into his bank. Could be the same bank, right? Could be a different one. Then that bank, right, is going to take $1 for every 10, so $9 to hold in reserves, and they're going to take the remaining $81 and they're going to lend that to person C. All right, probably know where this is going. All right, person C deposits that $81 that they have been lent, their bank is going to hold $8.10 in reserves. Oh, I didn't think about having to do this math. So what would it be, 72.90. All right, that might not be the right amount, but I think it is. Okay, not that it really matters, right? But this is how it would go on and on and on, right? Each time that somebody gets a loan, they will deposit it, right? Then the bank will take, in this case, 10% of that, hold it in reserves, lend out the other 90%, right? And this is going to happen until all of that initial deposit, so that $100 that was initially deposited, all right, until all of that is held in reserve, right? So it kind of continues on and on and on until all of that is held in reserves. All right, so that is how fractional reserve banking works. All right, so that, I probably shouldn't have erased that top part, but that's okay. All right, so that bank, that statement that banks hold $1 for every $1 in reserves for every $10 deposited, right? That is the basis of what we call the reserve ratio. All right, the reserve ratio is the ratio of reserves to deposits. All right, so however much gets held in reserve goes on top, and then we divide by the amount of the deposit. All right, so in our example, right, we had $1 held in reserve for every $10 deposited. So our reserve ratio is 1/10 or 0.1. All right, that is our reserve ratio. All right, we talked about how in the very first video we talked about how the Federal Reserve has some kind of regulatory aspects to it, and this is one of them. So the Fed sets a required minimum for the reserve ratio. All right, banks can reserve more than what they're told to, but they can't, reserve less, right? That's the whole point of a minimum, right? So if the bank says, or if the Fed says you got to hold $1 out of every 10 deposited, right, then this is the lowest your reserve ratio can be, right? It can be higher than that, right? If you want to hold $2 out of every 10, right, that would be perfectly fine, all right? But that is our reserve ratio. All right, similarly, all right, a related concept, oh, that's not what we wanted, all right, is what's known as the money multiplier. All right, so the money multiplier is the amount, the money supply expands with each dollar increase reserves. Right, it's also the inverse of the reserve ratio. All right, so MM, our money multiplier. All right, this is deposits over reserves. So in the case of our example earlier, right, $1 held in reserves for every $10 deposited, our money multiplier will be 10. All right, so what do we use this for, right? Well, we're talking about the amount by which the money supply expands, right, when we have this increase in reserves. And that's exactly what we're going to use this for, right? We're going to, that's exactly what we're going to use it for. We're going to use this to determine how much the money supply changes when reserves change, right? That can be represented with this equation. All right, so for any of you that are unfamiliar with this symbol, all right, this triangle, it's not actually a triangle, it's delta. And whenever we have delta, that just means the change, right, the difference, right? So we can read this as, so delta M, remember M is our money supply, so it's the change in the money supply equals the change in reserves times our money multiplier. All right, so by taking the change in our reserves, right, multiplying it by the money multiplier, we're going to get how much the money supply has changed with these reserves. All right, so once again, let's look at our previous example. So how much did the money supply increase when person A deposited $100? All right, so we're going to look the change in our money supply is equal to the change in total reserves. If we remember, as that money kept being lent, right, first person A deposits it, $90 is lent to person B, then what was it? $81 was lent to person C, and then the $72.90 would be lent to someone else, so on and so on and so on, until all $100 of that initial deposit are held in reserves, right? So the change to our reserves in this case is the $100. All right, then we're going to multiply that by our money multiplier, as we just saw. That is 10. All right, $10 deposits over $1 in reserves. All right, so the change in our money supply is $1,000. Right, and that is how we can determine the change in the money supply. All right, so a $100 deposit, assuming that that continues to get loaned out or lent. I never know which one the past tense of loan is. That $100 deposit, right, ends up changing the money supply by $1,000. All right, increases it by that much. All right, but that's it for fractional reserve banking. All right, so looked at kind of just what fractional reserve banking is. We looked at the reserve ratio, the money multiplier, and at how to determine the change to the money supply with a change in reserves. And that's it. All right. In the next video, we are going to start looking at the what I call the tools of the Fed. So, how does the Fed affect the money supply, which is going to affect aggregate demand through that change in the money supply. All right. But that's what we'll be looking at in the next video. I'll see you then.